$47 billion gone. They called it a revolution, but it was a machine. One man walked away with $1.7 billion, while thousands lost everything. This is WeWork, the startup that rented desks and burned the world. November 6, 2023. WeWork filed for bankruptcy. The company that convinced the world it was worth $47 billion died owing more than it ever made. But rewind 10 years, and WeWork wasn't a failure. It was a revolution. Desks with beer on tap, networking events, a physical social network for freelancers and startups. By 2019, WeWork operated in hundreds of cities. It had banks lining up, investors throwing billions. The founder, Adam Neumann, was on magazine covers, calling himself the future of work. The official story? WeWork was a victim of bad timing. COVID killed demand for shared offices, the pandemic crushed occupancy rates, and the business model collapsed under its own weight. That's what they told you. A tragic tale of a visionary founder undone by a black swan event. Except WeWork was already dying before the virus arrived. August 2019. WeWork filed paperwork to go public. Wall Street opened the documents and found something they couldn't ignore. The numbers didn't just look bad, they looked impossible. Here's what never made it to the headlines. WeWork had $47 billion in long-term lease obligations, but its customers? They only committed $4 billion. That's not a business model. That's a time bomb. The truth never appeared on TV. WeWork wasn't renting office space. It was gambling that tenants would keep paying faster than landlords demanded rent. And when the music stopped, there was no chair left. Let's go back to the beginning. 2010. Two guys in New York, Adam Neumann and 𝐸𝐿𝐸𝐿, sell an eco-friendly co-working space called Green Desk and use the cash to start WeWork. The pitch was simple. Lease entire office buildings, renovate them into trendy spaces with beer, ping pong, and community vibes, then rent desks to freelancers and startups at a premium. Flexibility meets lifestyle. It worked. By 2014, investors like JP Morgan and Goldman Sachs poured in millions. WeWork became the fastest-growing office tenant in major U.S. cities. Fast Company named it one of the most innovative companies in America. Then came SoftBank, 2017. The Japanese investment giant handed WeWork $4.4 billion. And suddenly, WeWork wasn't just growing, it was metastasizing. India, China, Singapore, hundreds of locations, thousands of employees. But here's where the design reveals itself. WeWork wasn't just leasing office space anymore. It bought a social network called Meetup for $156 million, a coding school, a gym concept called Rise by We, even a private elementary school. This wasn't diversification. This was desperation dressed as ambition. Because the core business, renting desks, was bleeding $2 billion a year by 2018. The only way to justify the valuation was to pretend WeWork was a tech company. Adam Neumann sold the story brilliantly. He called WeWork a physical social network, valued it using tech multiples instead of real estate multiples, and investors, drunk on SoftBank's Vision Fund billions, believed him. January 2019, WeWork hit $47 billion. But the architecture had cracks. Neumann personally cashed out $700 million while the company was still losing billions. He owned buildings that he then leased back to WeWork. He even charged the company $6 million for the trademark to the word we. He brought his wife onto the payroll. He made business decisions while drinking tequila on private jets. There were stories of him walking into meetings barefoot, smoking weed, talking about becoming the world's first trillionaire. This wasn't eccentricity. This was extraction. And the board? They let it happen. Because SoftBank's Masayoshi Son had bet his entire Vision Fund strategy on growth at any cost. Profitability didn't matter. Market dominance mattered. So WeWork kept spending, kept expanding, kept pretending the math would eventually work. By mid-2019, WeWork was burning through nearly $2 billion a year. It needed the IPO to survive, not to grow, to survive. Because without fresh cash, the $47 billion in lease obligations would crush them in months. Language matters here. The press called it aggressive expansion. The documents called it community-adjusted EBITDA, a made-up metric that ignored actual losses. But the truth? This wasn't failure. This was architecture. A system designed to transfer wealth from investors to insiders before the collapse. August 2019, the S-1 filing went public. Wall Street analysts opened it, and the illusion shattered instantly. Not only were the losses catastrophic, the governance was criminal. Neumann had super voting shares, 10 votes per share. He controlled everything. Within days, the valuation collapsed. $47 billion became $20 billion, then 15, then 10. Investors who were begging to get in were now running for the exits. The IPO was postponed, then canceled. WeWork was dying in real time. September 2019. Adam Neumann was forced to resign. His exit package? $1.7 billion. Think about that. The company was imploding. Employees were being laid off by the thousands, and the man who built the bomb walked away with nearly $2 billion. SoftBank had no choice. They had invested over $10 billion. If WeWork died, their entire vision fund strategy died with it. So they threw in another $9 billion, just to keep the lights on, not to fix the company, to delay the funeral. Then 2020 hit. COVID-19. Offices emptied overnight. WeWork's occupancy rates, already struggling, collapsed. Tenants stopped paying. But landlords, they still wanted their rent. The $47 billion liability was now a $47 billion noose. WeWork tried everything. Closed hundreds of locations, sold off assets at massive losses. Meetup, bought for $156 million, sold for under $20 million. The coding schools, the gym concept, all liquidated, all worthless. They even tried going public again. 2021. Through a SPAC, a blank check company. The valuation? $9 billion, down from 47. They raised some cash, but the bleeding never stopped. $3 billion lost in 2020, $4.4 billion in 2021, $2.3 billion in 2022. By mid-2023, the company was burning $646 million every 6 months. The stock price, which started at $10 in the SPAC, was trading under $1. Delisting warnings, lawsuits from landlords. The end was inevitable. November 6, 2023. Chapter 11 bankruptcy. $10 to $50 billion in liabilities. Thousands of employees laid off. Landlords left holding worthless leases. Small businesses that relied on WeWork spaces evicted overnight. But here's what the headlines missed. The actual cash burned wasn't $47 billion. That number was the lost valuation, the imaginary worth that evaporated. The real losses? $16 to $18 billion. Still catastrophic. Still one of the biggest wealth destructions in startup history. But not $47 billion. SoftBank alone lost $14 billion on WeWork, the largest single investment loss in venture capital history. Masayoshi Son admitted it publicly, called it his biggest mistake. But mistakes imply accidents. This was architecture built on delusion. But let's talk about the people who didn't get billion-dollar exit packages. The facility managers, the community managers, the people who believed WeWork was building the future of work and found themselves unemployed with worthless stock options. Landlords lost billions too. They had signed long-term leases believing WeWork was stable. When bankruptcy hit, WeWork rejected 160 leases outright. Buildings sat empty. Property values collapsed. Pension funds that owned those buildings, they took the hit. Small businesses were destroyed. A marketing startup in San Francisco, a design agency in London, a tech consultancy in Singapore. They had built their operations around WeWork spaces, flexible leases, no long-term commitment. Then, overnight, evicted. Equipment locked inside, deposits never returned. The system was rescued. SoftBank restructured. Creditors got paid pennies on the dollar. And yes, WeWork even emerged from bankruptcy in 2024. Smaller, profitable on paper. But the people, the workers, the tenants, the small investors, they were not rescued. They were the cost. May 2024. WeWork emerged from bankruptcy. A company called Yardi Systems bought 60% for $337 million. Remember, this was once valued at $47 billion. They eliminated $4 billion in debt, closed 160 locations, renegotiated everything. By mid-2025, WeWork claimed profitability. 600 locations, 35 countries. They won a Turnaround Management Association award. The business press called it a success story. But here's what profitability meant. They stopped expanding, stopped dreaming, started charging rent. They became exactly what they said they weren't. A real estate company. A landlord. The physical social network was dead. The community was gone. What remained was 45 million square feet of office space, managed by a company nobody trusted anymore. Adam Neumann? He's fine. After collecting $1.7 billion, he started a new company, a residential real estate venture called Flow, backed by Andreessen Horowitz for $350 million. He's pitching the future of living now. Same playbook, different building. The investors who funded him the first time? Some of them funded him again. Because in Silicon Valley, failure isn't disqualifying, it's a credential. Lose $16 billion, extract $2 billion personally, and you're not a criminal. You're a serial entrepreneur. So what actually happened at WeWork? Was it fraud? Was it incompetence? The answer is simpler and darker. It was a system working exactly as designed. Extract maximum value for insiders while selling a story investors wanted to believe. Growth at any cost. Valuation over value. The lesson isn't that WeWork was uniquely evil. The lesson is that it was normal. Uber lost $31 billion before reaching profitability. Snap has never been profitable. The entire venture capital model since 2010 has been built on this logic. Burn now, profit never. Exit before it collapses. WeWork didn't burn $47 billion in cash. It burned $16 to $18 billion. But it destroyed $47 billion in perceived value. And here's the difference that matters. The $18 billion was real money from real people. The $47 billion? That was a story, a fiction, a belief. January 2026. WeWork still exists. 600 locations, profitable on paper. But nobody talks about it anymore. The founder is raising money for his next venture. The investors moved on to AI hype. And the workers who lost everything, they're still gone. Still forgotten. Here's your scar. WeWork wasn't destroyed by a pandemic. It wasn't destroyed by bad timing or bad luck. It was destroyed by the same force that built it. The belief that narrative matters more than numbers. That vision justifies loss. That you can rent furniture, call it revolution, and burn $18 billion before anyone asks why. The company survived. The myth did not. Born from hype, died from truth. Forgotten in silence.